Welcome to Bayanat, the heartbeat of tech in MENA. We bring you raw stories and sharp insights from the founders, investors, and leaders building the region's startup ecosystem. Today, we're doing a deep dive into the career of one of the region's really key finance leaders, Yusuf Salem. He's the CFO over at ADNOC Drilling now. And his whole journey is it's a fascinating roadmap for how to navigate the capital markets here.
It really is. And
Yeah.
our mission today is to, pull out the concrete lessons for you. So whether you're a founder thinking about your exit or you're an investor who just needs some context on the market, we're going to track his path from, investment banking at places like QInvest and Moelis all the way through these huge regional milestones.
Right, like the Swivel IPO.
The Swivel IPO, the AIQ acquisition, and now scaling a massive multi-billion-dollar company at add-on drilling.
Okay, so let's start at the beginning. He has this very classic finance background. He builds his foundation at QInvest, which was Qatar's first investment bank, and then moves to Moelis and Company in Dubai. So for years, he's the advisor.
The guy on the other side of the table.
Exactly, helping huge companies structure these really complex M&A deals and capital raises.
But here's where the story gets really interesting. He's advising Swivel, the mass transit platform, on its path to list in the U.S. And that advisory role, it morphs into an offer to come in-house as CFO.
And you have to remember the context here. This wasn't just another job hop. It was, a massive moment for the whole region's ecosystem.
Absolutely. Think about it. Swivel becomes the first Egyptian company to actually go public in the U.S.
The first MENA unicorn on NASDAQ.
And at the time, the only mass transit tech platform on any major public exchange globally.
So this is completely uncharted territory, and he just decides to jump in and take full ownership.
And that's the core lesson right there. The fundamental shift from being an advisor to being an owner.
It's totally different.
It is. In banking, you give your advice, you collect your fee, and you move to the next deal. But when you're the CFO, you own everything, the whole outcome.
So it's not just the big capital raise anymore.
No, suddenly it's the nitty-gritty. It's accounting, it's tax, governance, all the SEC filings. He had to build a U.S. standard governance framework from basically nothing.
From the ground up, the accountability is just immense. You go from advising on risk to literally owning it.
Precisely. So let's talk about that listing. They chose the SPAC route.
Which was, at the time, the biggest Middle Eastern SPAC listing ever.
Right. And for a lot of founders, SPACs still feel a bit, murky.
So why go down that path? Why not a traditional IPO?
Well, Yusuf's perspective on this is really clear. They did not see the SPAC as an exit. It wasn't about cashing out early investors.
Yep.
It was purely a tool for raising primary capital. So they were comparing it to, say, a giant private funding round.
And the timing was everything, wasn't it? This was in that post-COVID zero interest rate world.
It was the perfect environment for SPACs.
Yeah.
When interest rates are basically zero, the opportunity cost for an investor to just park their money in a SPAC for a year or two is tiny.
So they could bet on the long-term story.
Exactly. They were betting on Swivel's long-term growth, its potential, not on its immediate profitability.
Now, here's probably the single biggest takeaway for any founder thinking about going public. Everyone obsesses over the share price and the market cap. But Yusuf says that's all secondary to one thing: liquidity.
Liquidity. So how much the stock is actually being traded?
Yes, the volume, the rate at which it's bought and sold.
But wait, doesn't every founder want the highest possible valuation? Why would a lower price with high trading be better than a high price that's static?
Because without an active market, without buyers and sellers constantly trading, that high share price is just a number. It's not real.
Oh.
Liquidity is what gives a valuation its reality. It's the engine that lets a stock price actually trend upwards over time.
So if liquidity is the real goal, how do you actually build it? I'm guessing it's more than just having a good P&L.
Oh, it's a whole playbook. It's about layered strategies, and you
Yeah.
have to target different kinds of capital. We can break it down into maybe 4 pillars. First, you start at the grassroots. You have to engage retail investors.
So the people on Robinhood, eToro, even Reddit.
Yes, you have to host AMAs, keep them excited, get them to understand the story. Second, you create training windows for hedge funds
How do you do that?
by timing big events. M&A announcements, capital markets days, events where they can plan and execute big trades.
Okay, that makes sense.
Third is the long game, earning the trust of big institutions. And you only do that by consistently beating expectations, quarter after quarter.
Beat and raise.
Beat and raise. And then the final layer is just pure visibility. maximize your free float, the number of shares actually available to trade,
Get analyst coverage.
get as much as you can. And crucially, you have to target getting into the big global indices, the MSCI, the FTSE. That's a non-negotiable for the huge global funds.
So becoming a public company is what, half building the business and half marketing it?
That's exactly how Yusuf puts it, half building, half marketing. The operations have to be perfect, but if the market doesn't see it and believe it, the value is just lost.
And that focus on strategy carried right into his next role. After Swivel, he went to AIQ.
The joint venture between ADNOC and G42.
Right, which was being prepped for a big IPO. But then, within 6 months, the plan just completely pivots. AIQ gets acquired by Pressite for $1.4 billion.
Which really proves his core philosophy.
Yeah.
You build optionality, don't just find it.
Exactly. All that hard work to get ready for an IPO, the tight governance, the clean financials, the compelling story, that's exactly what makes you a super attractive acquisition target.
The work is never wasted.
Never. And then after AIQ, the jump in scale is just, it's staggering. He becomes CFO of ADNOC Drilling.
So he goes from a tech company with a few hundred people to an enterprise of 11,000 employees.
An evaluation that's gone from around $15 billion to over $27 billion today. It's a whole different world.
And at that scale, growth is all about disciplined M&A.
And their playbook is incredibly rigid. They have 2 absolute non-negotiable conditions for any deal.
Condition 1, it must be financially accretive right away.
Meaning it has to positively impact earnings per share, dividends, return on equity, and return on capital employed.
So really quick, let's just define those for everyone. ROE is your profit relative to shareholder equity. And ROE is basically checking if the money you spend on the deal earns back more than it cost you.
Right. It has to create long-term value.
But that sounds so strict. Don't they risk missing out on innovative deals that might take a while to pay off?
Well, that leads to condition 2. Every deal must be strategically aligned.
Ah.
They will not do a deal that distracts from the core business, because that distraction hurts their core valuation multiple. The SLB land rig acquisition is the perfect example. It was accretive, and it fit perfectly with what they already do.
And I find their integration approach really interesting. It's about growth, not just cutting costs.
Yes, they focus on commercial integration, cross-selling, finding synergies. They don't just go in and try to tear apart the company they just bought to save a few bucks.
So zooming out a bit, this whole journey really shines a light on some of the structural gaps that still exist in MENA's capital markets.
For sure. I mean, we've got a lot of energy at the early stage. Seed, Series A, that's pretty robust now.
But there's a huge void in the middle, the growth stage.
Absolutely. The problem is for companies that are ready to scale big, the ones that need hundreds of millions of dollars before an exit, that layer of financing is still very thin here.
And the other markets that should help, like private equity, are still pretty immature.
Yeah, post-Abraj, it's mostly deal by deal. And private credit is emerging, but it's very focused on, a few fintechs like Tabby and Tamra.
And then you have the structural barriers in the public markets themselves. First, just basic eligibility.
Right. Most of the big exchanges here in the UAE, in Egypt, on Tadawul, they don't let you list if you're not profitable yet.
So if you're a high-growth tech company that needs to reinvest every dollar, the main door is closed to you.
The second big problem is just fragmentation. There's no single unified market in MENA. You have different rules, different licenses in every country.
Yeah.
It makes it so hard to build that pan-regional scale that global investors want to see.
And then there's the investor mindset. Local public investors here are very dividend-focused.
They want cash back now.
Exactly, which is the polar opposite of what a high-growth tech company needs. That misalignment is a huge problem.
And we can't forget the secondary market void.
Yeah.
In mature markets, you can trade shares privately before an IPO. It gives early employees and investors liquidity.
Here, it's basically all or nothing. You're either fully public or you can't trade at all.
Which leads to that classic chicken and egg problem. Right. How do you fix a market that's underdeveloped on all fronts?
And this is where the governments have to step in and act as a catalyst.
When state-owned companies, like the ADNOC subsidiaries, go public, they create credible supply.
That supply attracts the big international investors.
And once they're in the market, it legitimizes everything, and it paves the way for private companies to follow.
And that foreign interest is definitely here. I mean, ADNOC Drilling has over 60% of its public stock held by giants like Fidelity, BlackRock, GIC.
It's an overweight stock in emerging market portfolios.
And the reason is so important for founders to get. Global capital sees the UAE and the wider Middle East as a safe haven.
Compared to the volatility in other emerging markets, the region offers stability, stable governance, clear rules. And that's a huge draw for investors who want growth but also want to sleep at night.
The final lesson from Yusuf's journey, and you see it in his advisory work with Hub 71 and BCO, is that success really comes down to focus, trust, and just building genuine long-term relationships.
So wrapping this all up, what's the one big insight for you, the listener?
I think it's that building a massive venture is a two-part job. You have to be half builder, relentlessly executing your plan, and half marketer, expertly telling your story to a very demanding global market.
For more stories like this, subscribe to Bayanat's newsletter and stay updated on the latest in MENA's tech and startup ecosystem.